Hi, it's Eric Nuttall of the Ninepoint Energy Strategies recording live to you from Vienna, outside of OPEC headquarters, wrapping up 2 weeks of pretty steady travel. From my various meetings over the past 2 weeks, I would say it becomes very obvious that the Trump election was a reset in allowing the energy community to have conversations that not that long ago were taboo to have, such as the rapid energy transition, the role of oil going forward, demand growth expectations, etc. We've seen enormous volatility over the past week or so, owing to ongoing concerns around tariffs, concerns about the impact that those may or may not have on global demand. Specifically for Canadian energy companies, it feels like we've got headline fatigue at this point. My hope is that everyone that wanted to liquidate stocks based upon concerns of U.S. tariffs on Canadian oil companies have had that opportunity. We reinforce our messaging that full 10% tariffs on Canadian oil would only impact cash flow by roughly 7%. RBC came out with a report earlier this week and had estimates anywhere from 1 to 6%. And so, given fairly poor performance of Canadian oil stocks year to date, we do think that valuations are fully baking in a full tariff. We still, for reasons that we've belabored many times by now, do not think that the U.S. will implement tariffs on Canadian oil, despite headlines this morning suggesting the contrary. And so, we remain bullish on the outlook for energy stocks, given very robust free cash flow being generated now, the commitment of those companies to return that free cash flow via meaningful share buybacks. Trading desks in Canada report very active share buyback activity. We've seen public filings. One large holding had its largest share buybacks in its corporate history just last month. And given that oil has been holding up fairly well, free cash flow itself has not been impacted, but valuations have been imploding. We do expect many of our holdings in energy stocks, companies in general, to be very active on the share buybacks. And so we remain optimistic that energy realism, pragmatism is once again coming back into the conversation. Those who have been much more accurate with the forecasting, such as OPEC behind me, and the long-term forecasts outline scenarios where the demand for oil is going to grow much longer and stronger than consensus believes, on to population growth, increasing living standards, urbanization, etc. And yet we remain very worried about the ability of the world to satisfy that demand growth in the next couple of years. While it's true that OPEC does have a spare capacity, we estimate at roughly 4 million barrels per day. We would only have to erode about half of that to get to a level where I think the world would become very concerned. It's becoming obvious to us, and I think increasingly to consensus, that U.S. shale has entered its twilight. Guidance from public companies over the past couple of weeks during earnings season seems to reaffirm that, as have many of our meetings over the past couple of weeks with different entities. And so once consensus wakes up to the reality that U.S. shale has entered its twilight, at best it's going to grow by a couple 100,000 barrels per day, entering a period of plateau in the coming quarters to years, the world's really going to be reliant on long cycle production in a world where still public companies, at least, cannot invest in said long cycle production owing to their necessity to return free cash flow back to shareholders. So I'm going to wrap it there. This is the conclusion of 2 solid weeks. I'm looking back forward to returning home to Toronto. We remain bullish on the outlook for 2025, despite the very high levels of volatility so far this year, which we're hopeful once we get past some of the tariff noise and the market gets a bit of clarity, volatility will lessen, and the market will be able to see just how robust free cash flow and free cash flow yields are for public or companies.